Normally, I would ask you what financial managers would have to decide about. I would ask you what are the roles of financial managers, what the examples they have to decide in their job. But you would answer to me because you are very smart students. And obviously, we would find very, very quickly that one of them is the question of investment. How to approach investment, how to decide about investing money. Because, you know as anybody in the world, that spending money is easy. You could spend money quickly, without thinking, impulsively. But investment is not just spending money. It is about spending money, but in a way that would bring more money in the future. This is investment. And if we hope that it will bring more money in the future, so we have to determine if the investment is good or is bad. But what does it mean that the investment is good or is bad? We have to think in a scientific, financial way about that. We are going to be able to measure if something is good or something is bad. And then, already if we determine that something is good, the investment is good, probably it will bring much more money that we have invested. But then, how good is it? So, we will try to find some basic tools, mechanisms, formulas to calculate how good the investment is. Or is it good enough? Because this is again a question. Is it good enough for our standards? Maybe if it's good enough, we will just accept it. Then, if we think about how good is that, how bad is that, we have to again think about that we have to design some assumptions that must be taken into consideration. We have to put some frames in which we are going to decide, because it's as a matter of fact, it's like a question: is it tasty or is not tasty? If somebody does not like salty food at all, and you give this person something a bit salty and very salty, both of them would be out of the consideration because he doesn't touch salty at all. So maybe it's important to think that before thinking about a project, a given project with certain numbers, we have to make some assumptions. Is it at all applicable? Again, there's a number of these factors. And then once we are managers and once we have some tools to calculate, then what procedures of evaluation we would implement. So we have some tools, but then what is step by step this procedure that we are going to implement in assessment of our project? This is very important. So yeah, please think about that it's a very vast area, and we will have to select just a couple of tools or procedures. There are not too many, but and some of them looks simpler, some of them looks more complicated. Obviously, we do it on the sort of first level of complication. So this investment analysis. So when we are doing this, and I mean when and why. So companies as legal entities, they need capital. Normally I would ask you, I would just go to the class and ask you. You are smart, you know the answers, you would give me surely, but I had to write it down because it's pre-recorded. So, yeah, they need capital, obviously, to grow, to expand, and as well to renovate existing business. So we have this example of a bus company running buses and travels between the cities. So they need to firstly be sure that the buses are up to standards. So if they are old, they should be replaced by new ones. And if there are more and more lines conquered, more and more buses are needed. Or say this bus company operate in Tallinn, but this bus company would like to operate, say, in Beijing. Then there's like a new business unit. Or they operate buses, but they think they will operate taxis, for example, or car rentals. So this is a need of the capital. And then the role of the financial manager is to convince the bosses, the operating management, firstly, that this investment will be profitable at all. I mean, it has to be profitable. But as usual in life, when there is some profit on the horizon, there is obviously what? Yes, you have it. There is some risk. So this investment has to be favorable, and the return, and it has to meet the investor's sort of hurdle, sort of line of minimal risk. Because we could imagine and we could prove that something was hugely profitable once or twice at a huge risk, but several times it was not. So it's not acceptable for the owners. So this is the fundamental that we are talking right now. So we are now approaching the first method. It might look fairly simple, but there are some traps in it. So let's approach this first method of evaluating the investment for future. Sort of what we are doing. Maybe I will say again. We have some amount of money that we put into a project. Very quickly, the project starts. It generates returns. So what kind of a return it generates? Then we have how to evaluate this. The first one will be the payback period method, or short payback period. Already the word period indicates that it's something related with time. So we have the definition: the amount of time required for the investment to generate cash flows sufficient to recover the initial cost. Saying in quite popular language is, we have some money, say 100, we put to the project, it generates flows, and we wait and we find a point when all 100 is returned. So in this concept, next flows will be like profit, like this clean profit. This is not a accountancy expression, this clean profit. So method would be, as I just said, add the cash flows each year until the sum is equal to the initial investment. And how we make the decision, because this is important, because you could say if the project is profitable, most likely sooner or later it will pay back. So what's the point of the whole bloody method, you might say? Obviously, sorry for the language. And you are right, because this is the key idea in this method, is this when the benchmark. Because The management say, we would generally accept the project if it pays back in less than or not longer than 3 years. So if during 3 years it's paid back, it's okay. Fine, we love it. But, so this is the benchmark. So acceptance is when it's within the benchmark, and rejection when the period is longer than the benchmark. I understand that at the moment it might sound all sort of weird to you, but don't worry. Now we got a feel, and it will be very tangible feel. The illustration. You are a student. Say you are studying for 5 years at the university, and you find that you are going to spend $6 per week on the laundry because there is a local washing laundry facility. $6. So you stay there the whole year. To make it simple, it makes about $300. That it's sort of given away because you make this laundry once per week, so you have to be careful with the stuff, not to wear too much. It costs $300. And then you think, oh, maybe I will just buy a washing machine. But the washing machine costs $800. And you think, let me think. I want this to cover my 3 years, and then I will use the machine at least for 2 years till I will just get rid of this on the scrap because I will not bother. So it's important to me that it's paid back within 3 years. So in this sort of concept, I hope you follow me. You have the decision. You just spend 3 years per 300, or you buy the machine. Obviously, we take the sort of assumption that there is no electricity and there's no powder, so on. Okay, just to be clear for this idea. So then you think, all right, instead of spending 900, I will buy the machine for 800, so I'm better, and then I will use it for free for later years. So this is the idea. If it would have paid for itself within 3 years, it's worth doing this investment. So how to calculate this? This is again, the procedure. I have prepared for you the procedure, how to do it. The steps. Set the arbitral way of the required time frame to pay back the project. This is a fundamental idea. This is arbitral. This is, somebody would say 2 years, somebody would say 3, somebody would say 4. Doesn't really matter. Some boss somewhere would say this is the time frame, and we do not pass this. Then the step number 2 would be with figures to calculate the actual payback period. Calculate how much time does it take. And then the step number 3 is to compare the project with this payback period. If the payback is smaller than the required time frame, then we accept it. If it's longer, we reject it. This is the very clear black and white plus minus decision. Yes or no. So we have now another example. So let's try it. You will calculate. The example is again from the tourism industry, or rather entertainment, I would say. So it looks like that. There is a company offering hot air balloon trips, and the balloon costs $300,000. And if you have this balloon, then these sales or rather revenues, would increase by 75% per year. And you will have to do the calculations and the decision, because step 1 already is here. The requirement is that this project has to pay back within 5 years. So I would now ask you right now to make an attempt for the calculation for a minute, perhaps, or even less. The balloon is 300,000. If we buy it and if we implement this, it will bring us 75,000 per year. And our bosses say that the project is to be accepted if it pays back within 5 years, sort of not more than 5. Have you done the calculations? So first answer would be in how many years it pays back, and the second answer would be to compare it and accept or reject. So let's go down for the figures, and it's like this. This cost of investment 300,000 divided by 75,000 equal 4. So 4 years. It pays back within 4 years. Step 3, this 4 years is smaller than 5 years that was given us by the management, so it means that we should accept this project. Fine. So you might say, it looks pretty simple, which is fair comment, but then we have to evaluate this, and you would say, most likely this procedure has quite a number of weak points. Like the first one, we might say, yeah, but it ignores totally all cash flows that are after the cutoff date. We just don't know if after this arbitrary put number of periods, if there is any other nice income or there is none at all. How we deal with that? This method entirely ignores that. Then this method gives equal weight to cash flows in all years. We already started this subject, and we know that time is money. So it just ignores money and time in all these calculations. And we might say if the interest rate is low and the period is short, perhaps it doesn't matter too much. But still, we ignore this. Then this method entirely ignores the scale of the project, because it's applicable to very small ones or to the huge ones. And still, if we have in percentage, maybe perhaps these returns are the same, but as we know already, it's not the same to have compared 12 to 10 or 1,200 to 1,000. The scale is as well quite important. And then the biggest sort of critique of this method is that this number of periods, this cutoff period, was introduced entirely arbitrary. So the boss says it has to be 3 or maybe 5 or maybe 2, and how he decides about that? There is no clear view. Why is that this number? If we said that this method has some considerable weak points, we might put a question, so why do people use it at all? If it has so many weak points, pretty obvious weak points, why is it used? This is quite interesting. Because there's a number, again, a large number of issues. Why is it used? Firstly, because of its simplicity. You could put forward this method even to people that have no education in economics or finance. It's very easy to communicate this idea of investment. Anybody, and absolutely anybody in the company, could understand this issue, this idea. Then people tend to make these payback periods relatively short, maybe 3 years, maybe 2, rarely 4 or something like this. Because managers in large corporations, they may like it, because if there are shorter paybacks, then it means quicker profits, and then the quicker way of promotion within the corporation, within the company. So this is like why it may be liked in very large companies. And as well for small companies, small family companies, for the people that do not have too much qualification or too much education, it's easy to grasp, and as well it's easy to implement. And which is as well quite important, these small companies, they might worry about the future and ability to raise the capital, so they put the cutoff period rather short for rapid payback. And as well, for smaller scales, it doesn't really matter too much. I mean, if we calculate this, say, laundry machine, as I used this example at the very beginning, we just do not care too much if it's rounded up, rounded down, several figures there or there. For small investments, small purchases, if it pays back, then it's okay. Let's assume we are at this farmhouse. Yeah, we run this business, farmhouse agritourism, and we think about, should we invest into new, sort of bigger, maybe more efficient washing machine. This is the example. We just don't care too much. So for easy projects, it's straight and it's very easy to do. But obviously you would say, yeah, but when these flows are sort of more complicated, what should we do? How should we calculate? Again, we have this nice example of payback analysis, and we are in a hotel, or rather a place for relaxation, quite a large one, and we are replacing a spa, and it will cost £100,000. The business will use the spa facilities for 5 years, after which it will be residual to 0. Yeah, so we think about this project like that. And the spa is generate cash gains. Is to generate cash gains, 50,000 first year, 40,000 in second year, 25 in year 3, 30 in year 4, 25 in year 5. Please write down now on a piece of paper or your notes, like 100,000 as a 0, and year 1 50, year 2 40, year 3 25, year 4 30, year 5 25. I hope you have written this, and we should use the payback method for this project, and we use cutoff point of 3 years. So please make a quick calculation right now. Should we accept the project, or we should not accept this project, and on what basis? Please, maybe several seconds, please calculate. Okay, I hope that you have calculated this. So let's see how it looks like. It looks like that. We have this cash flow, I mean, in several directions, like 100 that we put, and then we have like 50, 40, 25, 30, and 25. And we accumulate this sort of accumulated cash flow for that. So at the beginning, we are like minus 100 after the year 0. But after the year 1, we still have like 50. After year 2, because we earned 40, we're still about 10 on minus. But in year 3, we receive 25. So after the year 3, we are positive 15. So already we know that this payback would come between the year 2 and 3. Already. And already we should say that we should accept this project because it's less than the cutoff point of 3 years. But then if somebody insists on exact time when we should do it, then there is a tool that we calculate the amount of year. We just take this remaining 10,000 in a year 2 and we sort of divide it by the flow that happens in the year 3, this 10,000 divided by 25,000, and it gives us 0.4 years. So we add it to the year 2. So in total, it's 2.4 years. So it's less than 3. So we should accept this project. If this was maybe too challenging, I don't know, then we look on another example. Yeah, this shows this 10 to 25, and then again this that it below the year 3. Say we have this. Look how it looks like again. How long in this case the payback of the original investment will take. We have 100 that it's spent, and every single year we have 25,000 pounds. So how many years will it take? As this, because it comes 25 in the year 1, 25 in the year 2, 25 in the year 3, and 25 in the year 4. So this comes under like payback of 4 years. And then we have another important question: how we could compare on the example of 2 different projects. How could we compare? So look, this shows 2 projects, A and B. And if we have the cutoff point of 4 years, we could make now the very fast calculation: 21 plus 28 plus 38 plus 15. And we could see that within the year 4, this project would be accepted. The other one pays back in 5 years, 28, 23, 2018, and in year 5, it goes over 100. So if we do it on the basis of 4 years cutoff period, then we accept project B. However, when we look closer, we neglect, this is the weak point, we neglect what happens after. And in case of project A, the biggest money comes in the year 6. So this is this disadvantage shown in practice. Let's summarize this small recap before the end of part 2 of our lecture. That advantages: it's easy to calculate, suitable for short-term projects where discounting is not significant, and allows as well, this is important, to compare investments in different conditions. Disadvantage: it completely ignores the time value of money, completely ignores cash flow after the required payback period, and as well, this is a very big disadvantage, arbitrary cutoff point of decision instead of cutoff time.